Welcome. This is Virgo Arbitrage. My name is Miguel. This is lecture number 1 of some fundamental concepts of financial economics. The points that we are going to tackle are the following. Why this lecture is important, what are stock prices, crypto, indexes, ETFs, and we will review some concepts of financial economics like GDP, inflation, labor markets, interest rates, money value, capital cost, the capital asset pricing model or CAPM, risk, and portfolio theory. Why is the lecture important? Okay, if you are here, it means that you want to gain money. You want to take control of your money. You want to make a profit. And you want to take, by the end of the day, this means that you are gonna take a decision. You are gonna buy an asset, keep it for some time, and then resell it and get some benefit about this transaction. And market, it is exactly like that. There are many players like banks, hedge funds, investing funds, governments, you and me, who are gonna do the same. They are gonna buy stocks, they are gonna buy assets, keep it for some time, can be some minutes, can be some years. They are gonna wait for benefits and then resell the asset and get a benefit. This is the way it is. It is a balance, and it is a delicate balance if there exists a balance, but there are winners and losers. It's the way that market is, and if you want to make money, you have to take a good decision. But most importantly, you have to be very conscious about what to do when things go well and what to do when things go wrong. Stock prices. To understand stock prices, first of all, we have to understand the financial results of a company. And to do so, I will give you the following example. You can see the table on the right side. We have a financial statement. This is a cash flow. On top, we have the income, which is the output of the sales with no TBA. And they are directly related to the main activity of the company. Then we have the expenses, which are all the direct costs related to the main production activity of the company. Let's say we have 4,000 as income, then we have 2,000 of direct costs. We subtract both, and then we end up with 2,000. This result is called gross revenue and is the result of the company related to its direct production activity. Then we have operational expenses. Operational expenses are all the other expenses related to running the company. Let's say management, marketing, consulting, maybe rent, etc. Let's say for this company, the operational expenses is 1,500. We subtract this amount from the gross revenue, and we end up with 500, which is the operational revenue. The operational revenue is very important to check in a company because this will give us the output of running a company. And we as investors will look for green numbers, strong operational results, which means that the company is running in an efficient manner. Sometimes it's not the case. For example, big startups like Facebook, they had operational revenue in red for a long time, but what investors were looking for is to get green at some moment in the future. Okay, let's continue. We have the financial costs. For this company is 361, which is the interest of the debt. Then, okay, before proceeding, let's see. The amount looks a little bit big. It means that maybe this company have a big debt burden, and that's why the interest costs are high. But this analysis, let's keep it for later. Okay, we have if we subtract the financial cost from the operational revenue, we end up with the revenue before taxes. This is gonna be the amount that we are gonna apply the tax percentage, and finally we subtract this amount and we end up with the net revenue. This net revenue is the money that is gonna be distributed to the investors or owners of the company. Now that we understand how a company runs financially, let's understand a little bit of valuation. Valuation is the process to find the value of a company, and in order to do so, we need the financial results of a company from net revenue or cash flow from the future. From our previous example, our company's result was 100, and let's use this number as our benchmark for future revenue or for future cash flow. Let's say that within 3 months and 6 months, the expected result are going to be the same, 100. However, today's value of this money is not going to be the same. For example, $100 within 1 month is not going to be the same as $100 within 1 year, because more or less in one month we can predict what is going to happen. We are more or less sure that things are not going to be, let's say, so chaotic. So we can rely on $100 within 1 month. However, in 1 year, a lot of these things can happen. So it's not sure that we are going to receive $100 within 1 year. So the risk is higher. So therefore, higher the time, lower the valuation of the money into the future. And that's why if we assess, for this example, $100 within 3 months is 90, within 6 months it's 80, which reflects the uncertainty of the time and also our financial cost. We will talk about this financial cost or interest rate in a coming lecture. Don't get scared. Okay, coming back to the example, let's say that today's valuation of this company, which has 10 stocks, we are gonna sum the today's value of the future results. We have 100, 90, and 80. We sum them up and we end up with 270. We divide this result by 10 stocks and we end up with $27 stock price today. But this is gonna be, let's say, one opinion. This can be my opinion. For you, can be another number. Let's say you believe that the value of the money in the future is higher. Therefore, the today's value are gonna be lower. So maybe for you the stock price is 25. For another investor, maybe it's 28. So there are multiple opinions because unfortunately we don't know what is going to happen in future. We don't know how the company is going to behave in the future, or market, or providers, or customers. So that's why stock prices change every day, every minute. It's not going to be a flat number. Well, there are some stocks that are kind of flat, but most of the stocks fluctuate. Prices go up, go down, because investors they expect money from the future. They don't care about what happened in the past. Of course, what happened in the past is a good source of information. So they can they can analyze what happened in the past, and they infer. They take this information and they can infer what is going to happen in the future. But in the end, the thing that happened, they are going to come back again. So they are more, let's say, looking forward what is going to come, because the money is going to come from the future, not from the past. So that's why stock prices changes, and even opinions between investors is not the same. For example, as I already said, the value of these stocks can be some number for me, and another number for you, and another number for BlackRock or Street Bank. So if you want to understand why stocks go up and down, it's a very complex, let's say, a very complex dynamic between what is going to happen with the company, what is going to happen with the market, the opinions of investors, news, fear, excitement. There are a lot of things that happens in market. You can see that it's maybe chaotic, but it's the way it is. And one big advantage of stocks is that we can use past results as a kind of benchmark to assess what is going to happen with the company in the future. For example, before I said that companies with green operational results are strong. So we are gonna be confident about those companies. So this number can give us some security to invest in certain companies, while for other companies, like for example Facebook some years ago, where operational results were red, it was an up and down roller coaster, and it was very risky, but investors make money out of it. So it depends on your preferences, on your valuation, and on your expectations. And now, let's go to crypto. Okay, crypto as a technology is meant to be a decentralized foreign exchange that do not rely on banks or authorities or central banks or governments. It's meant to be a free asset circulation, which is supported by a network of users who owns the crypto. As an asset, it works as an electronic money of free circulation, which means that you and me, we can exchange freely, and thanks to a wallet crypto, we set a price and we exchange. We have for crypto a fixed supply. However, fixed, I would say in brackets, because when it's released, we have a fixed amount that won't increase into the future, but it can reduce thanks to a mechanism called halving. What drives the crypto value? Okay, some things. For example, supply and demand. Buyers and sellers who want to exchange crypto, they are gonna pack the price. Therefore, price is gonna fluctuate across the time. Another thing that is gonna impact the crypto's value is halving, which is a procedure of half the total available amount of crypto available in the market, but not all coins have this property. And market capitalization. Market capitalization is the global acceptance of a coin. For example, Bitcoin value is very high because it's broadly accepted by all the internet users, while other less popular coins value are very low. We can interpret market capitalization as popularity of a coin, and this popularity makes many coins very volatile, because for one day to another they can increase in popularity, therefore in price, and other can become obsolete, therefore decrease of the value or the price of a given coin. Another drivers, it's platform rewards. Some crypto are or coins are attached to an app or to a company, and they for example, football clubs like Juventus or Barcelona, they have their crypto, and when there are, let's say, more rewards, more popularity, the asset price is gonna go up, or when there is something is wrong and the rewards are poor, their price is gonna go down. Indexes and ETFs. Okay, world indexes. First of all, let's understand an index. An index, what it's gonna do is to track the behavior of the market. It's gonna use very simple operations like sum and maybe a weighted average. There is no big math behind indexes. We have in the market many indexes. The most popular, I listed here some of the most popular indexes. For example, Dow Jones Industrial Average coming from the United States. This is a weighted average of the 30 most prominent stocks like JP Morgan, Chevron, Johnson & Johnson, etc. We have S&P 500, which is another weighted average of 500 stocks across several industries. It's a very broad stock, and is commonly used as a, let's say, basic benchmark of how market is behaving in general. And the way that those stocks are selected are representativeness and market value. We have Nasdaq, which tracks technological companies. We have DAX, that tracks 40 major German companies in the Frankfurt Stock Exchange. We have FTSE from the UK and CAC 40 from the French market. Then we have ETFs. ETFs is a little bit related to an index, but it's calculated differently, and there are more, let's say, some tricks behind them. There is more math behind. They are assets that are gonna track a given portfolio or a given subject. For example, there are ETFs that tracks developing markets, AI startups, telecom companies, banking, gold, crypto companies, etc., etc. There are a lot of ETFs. One of the big advantages of ETFs is that they are already diversified assets. We don't have to care about diversification for ETFs because they are already diversified. Maybe if you are already familiar with ETFs, you think that ETFs are they do not have too much volatility, or they don't fluctuate too much, but they remain stable across time. The trend are not so how can I say that? The trend are not so high or so low. They are good trackers and investment options if you want something safe to invest in. Okay. Fundamental of financial economics. The first batch is GDP, inflation, and labor market. Let's start with GDP. If you are already familiar with financial markets, you already heard that GDP is quite popular in financial markets as a new. But if you are not familiar, I give you a quick description of it. GDP has 4 components. GDP first component is personal and public consumption, plus government expenditure. The third component is public and private investment. And finally, we have the difference between exports and imports. We have economic agents for each. For example, for consumption, can be buyers and sellers, can be you and me and a store, or a big chain of supermarkets like Walmart, Carrefour, etc. In government expenditure, we have the government, for sure. In private and investment sector, we have big banks, can be also normal banks, and one important player is the central bank. For example, in the US is the FAD, in Europe is the central bank, European Central Bank, and in the UK we have the British Bank. And finally, export and imports, we have companies who have who work with foreign markets, and companies who import goods. Why is it important in markets? Well, investors uses a lot the quarterly reports, and companies base their strategies according to how the economy is going to behave in the future. That's why companies look for economic growth. Economic growth means a good sign of an economy. It can mean a lot of things at the same time. For example, employment and company creation, or a good environment for entrepreneurship, security for big companies to do business, and even for governments, this is a good sign because they can invest in the economy and have a return. All those components are gonna, it means in the future, more sales, more benefit, more revenue, and finally dividends and a stock that is gonna go up. When the economy is not growing, there are other type of companies that are gonna thrive. For example, second-hand goods, maybe banks, or other new industries that can emerge, but they are not common companies. Here, a government, when the economy is not going good, they are gonna be very proactive. They are gonna do some interventions like cut taxes, invest more, or cut interest rates so that economy becomes more dynamic. But we will talk about interest rates later in the section dedicated to it. Finally, we have inflation and labor market. Inflation is very simple. It means the variation, the percentage variation between a basket, a benchmark basket from one period to another. And it's quite important in market because it's gonna impact directly the consumer sector. Then we have labor and unemployment market. This metric is followed also because it means that companies are created or companies are gonna hire or are hiring employees, which by the end of the day is gonna mean more consumption, maybe saving, and then investment. And another factor to take a look is investment and debt. Now, let's see interest rates and value of the money and the role of central bank. Central bank and the interest rates. The missions of the central bank. Manage international funds. International funds is money that is invested in the international market or international projects. This money is used by the central bank so that it grows and then is used for specific missions like control foreign exchange. For example, when foreign exchange is weak or very high, central bank can use this money to buy foreign exchange and to control or to balance or stabilize the money in the economy. Another mission of the central bank is money market. Central bank is responsible for the printing and availability of cash in the economy and also debt. And the third mission of central banks is interest rate of reference. Interest rate of reference can be a little bit abstract. It means the price of the money, and it has many instruments of how central bank can control for that. But a quick example is that is the price of bonds or other financial instruments so that banks can borrow money. If the interest rate of reference is very high, it means that the money is expensive and banks, well, let's say consumption and investment banks are not going to borrow because money is expensive, therefore less money in the economy. But when interest rates are low or central bank is low in the interest rates, it means that the cost of the money is cheaper and banks or companies can borrow more money. Therefore, in the economy, we will have more money available. And finally, the main mission of central bank is to control inflation. The previous missions I said, the final consequence is going to be to control inflation. Central bank has a target to stabilize the money in the economy, and in order to achieve this, is going to control the availability of money and the cost of the money in the economy. Now let's talk about capital cost or interest rate. Maybe in the previous slides you already heard that I said this term capital cost or interest rate, but what is? In simple terms, it is just the price of the money. If you are quite new in this field, money has a price and it's the interest rate or the capital cost. The money you have in your wallet, in your bank account, has a cost, and the money I have in my bank account has another price, another capital cost. And for every person, it's gonna be different. But before to jump in this concept of subjectivity of capital cost, let's talk about first of opportunity cost. In simple terms, opportunity cost is for some options, it could be the interest or the return, but it is also the best opportunity that you are losing for taking a decision. Maybe it's a little bit trickier, but let's check it in some examples. The first option you have in front of you three pictures. The first one is a bank deposit with a return of 1% with risk zero. Risk zero because it's quite sure that we are gonna receive the money or the interest by the end of the capitalization period. Let's say 1 year. The second picture, we have an entrepreneurship project which expected return of 20%, but it has some risk. Everybody knows entrepreneurial subjects, not only tech startups, but any entrepreneurial motivation or project has up and downs. There are some projects that fail, there are other projects that succeed. Because of this uncertainty, we have more risks. Our expected return is going to be higher. So risk and return go in the same wavelength. Here the expected return is 20% and the risk is 50%. We can lose our money or lose some of it, or we can win the expected return, or we can win some money but not as high as this expected return, or we can even earn more than this expected return. So as you can see, risk is broad. Risk plays in both directions, either in green numbers or red numbers. And finally, we have invest in stocks. We have an expected return of 10% and a risk of 5%. If we have sufficient proficiency and experience in market, we can make money and have a low risk, because we gain some, let's say, some confidence, some good strategies, intuition. So our risk is gonna be lower, but returns are gonna be lower as well, because we are not gonna risk too much. Otherwise, we're gonna prone to lose our money. Not all our money, but we are prone to lose money gradually. The money cost has two components. The first component is free risk return. In corporate finance or financial market, normally we use the Federal Reserve interest rates, but let's say for people like you and me, a bank deposit is a good benchmark. Then we have the risk prime. Risk prime is how much extra return or expectation return we expect from our decision, from our investment option. And this is quite subjective, because for some people, some assets are going to be more riskier than the others. Even if we do a statistical analysis and all these fancy math, by the end of the day, it's going to be very subjective. What for us is going to be low risk, for another people is going to be quite different. And let me show you the following example. Let's say we have in front of us an investment opportunity, and this investment opportunity promises to give us $100 every month. For investor A, let's say this is promising, so the value nowadays of the future money is gonna be not so low. So very likely he's gonna take this decision, and he's gonna go for this investment opportunity. However, for an investor B, let's say he's a very skillful investor in the stock markets, he realized that maybe this investment is not too promising, even though the contract is the same. But for him, his opportunity cost is way more higher. So he has in his portfolio, or in his job, let's call it portfolio, other opportunities that worth more the money, whose money is gonna be invested more efficiently. Therefore, he's gonna earn, he's gonna get a higher return. So therefore, the investment opportunity that he has in front of him is not gonna be so attractive. So he's gonna have a high opportunity cost, and the future and the current value of the future money is gonna be lower, and therefore the valuation of this investment opportunity is gonna be lower. So with this example, what I want to show you is that opportunity cost is quite subjective. It's gonna depend on people, how you perceive how you perceive assets, how you perceive the opportunities, and also reflects how prone you are to take decisions and your attitude toward future returns or future money. Now let's talk about a very popular concept in financial market, which is the CAPM, or capital asset pricing money. It's a further extension of opportunity costs. The first component is risk-free return. We already talked about that. The second component is the risk premium. We already talked about that. Here it extends a little bit more. in this case, in CIPM, the risk premium is the difference between the risk or the expected return of a given asset minus the risk free return. But in simple terms, it's the same. It's how much return I'm gonna ask for the opportunity I have in front of me. But we have an extra component, which is the beta, which is the market sensibility. What is the beta? Now we are gonna start to talk about a little bit market. Let's say that market, let's consider Standard & Poor's 500, Standard & Poor's as our benchmark. Let's say that in 1 year we get a 20% return if we invest in companies of SAP. But we find we did our research and we realized that there are other investment opportunities that can give us way more money. Let's say 30%, 40%. This beta, what it's gonna measure is how exposed is those new opportunities compared to Standard & Poor's. Let's say if beta is 0, that means that the expected return of those new opportunities is nothing related, is independent. So what happens in market is not correlated or is not related to what happens in our portfolio option. Let's say that beta is 2. If beta is 2, it means that if market fluctuates, it grows, let's say 20%, very likely our investment opportunity is gonna double. Or the other way around. If market falls 10%, our investment opportunity is gonna fall 40%. Very risky, you see? It can place in both directions. It's kind of leverage indicator. I think it's worth mentioning that beta is a leverage indicator. If it's higher than 1, it means that our investment opportunity is very sensitive. It's leveraging of what's going on in market. Normally, investors look for opportunities that are not related to market, but this is one strategy. Other investors are gonna look to mimic what's going on in market, because sometimes market is going well, so trying to benchmark and to mimic what market is doing is a good strategy and a good practice. Later we will talk about that more in detail. Let's discuss further risk. In this slide, I would like to give you extra details about risk. In the previous examples, I already mentioned and developed a little bit the concept of risks, but let's extend. And let's say that we have in front of us an investment opportunity of 10%, but it has a risk of 10. In median terms, let's say 10% is our expected return. If we add one layer of risk, we will sum and subtract 10 from the expected return from 10, which means 0 expected return in the lower interval and 20 in the higher interval. What we can interpret from that is that we can even win no money, or we can double our expected return. Quite good, right? Let's go further. Now we add a third layer, or well, a second layer, and let's sum and subtract 10 from the previous interval. We get minus 10 and we get 30 expected return. Now we can see that we can lose money. We can lose 10%, or we can earn 30% return. Quite good, right? So this is a very graphical representation of risk. Risk plays in both directions, winning and losing. most of the time we have a, a bad idea of risk, but it has also a positive side. In financial markets, if you want to make money, you have to take risks. You have to look for assets that fluctuates because they are losing money and sometime they are gonna start to win. Or we are looking for something that is gonna be unexpected with very high risk, because this could mean very high returns. Another concept I would like to talk about risks before going to the next section is risk. There is always risk. There is no, in market there is no high return, very low risk opportunities. If you want to avoid risk, the best option is to take a bank account or invest in bonds. They are quite secure, but the expected return or the money you will get by the end of the exercise is gonna be quite low. So if you want to make money, you want to take risk. It's very simple. Now, in this section, I would like to talk about portfolio theory and how it relates to opportunity cost and risk. Diversification has a very nice property, which is to reduce risk and to diversify our investment options. Let's say we want to invest X% of our money in stocks, some other percent in a bank account, and the other percent in crypto. We do not put the same money in the same basket or in the same opportunities. Very risky, because if this asset goes down, it means that all the money is gonna go down, and we don't want to lose money or to feel anxiety about our money. We want our money to grow. So what we are not gonna look for is to look for assets that are not correlated. What does it mean, correlation? Correlation means, let me give you this example. Let's say that Standard & Poor's and Dow Jones indexes are correlated, because when one goes up, very likely the other one is gonna go up. If one goes down, very likely the other one is gonna go down. This is correlation. If we invest in both indexes at the same time, we are, in terms of risk, we are doing nothing. We are not diversifying. We are just investing in very similar assets. We are not taking, let's say, we are not taking care of our money. But if we invest in an asset that is not correlated, let's say one asset go up and the other stays stable, in that case we are diversifying. Maybe you see that the other one is growing, but the other one maybe is decreasing. Yeah, this is part of the correlation, but it's better to have to be in this situation than in a situation in which both assets are going down, because we are losing more money. So the thing of diversification is to avoid losses and to secure our expected return. Very simple. So that's it from this lecture. Hope that you enjoyed the video. I know it's a little bit long. There are many concepts to cover. The field is very extent. I explained those concepts as friendly as possible, because I know there are people who is new in this field. I want they have a good comprehension of those concepts. So if you feel motivated to learn more, I will share with you some extra videos that will explain further each concept, or maybe I will share with you other crash videos so that you can get more understanding, more knowledge about this topic. Is for me, from my personal experience, is quite enrichful, because I learned a lot how economy works, how financial market works, how stock market works. And this is very important, because if you know how it works, you will start to build the base knowledge to get intuition in financial market. So please leave me a comment, stay motivated, and see you in the next lecture. Bye.